What do you think the biggest risk that is facing the economy right now?
The labor market is dramatically deteriorating. It's not that the stuff is going to hit the fan, but the stuff is hitting the fan. We're not there yet, but you see it kind of trending higher. The market is always ahead of the Federal Reserve. Always. It's the same cycle that we've seen going all the way back to the 1950s.
Gold, Bitcoin, and farmland. Which do you think is going to outperform the most?
The conservative investor in me, which is what I am at the end of the day, would say gold.
Welcome back to the Gold Exchange podcast. My name is Ben Nadelstein. I'm joined by the one and only George Gammon, the rebel capitalist. George is, in my opinion, one of the best thinkers in the entire world for the intersection of macro, liberty, investing. He's built a reputation for cutting through the noise, bringing together rebels, investors, freedom-minded people, all at the rebel capitalist events, which I hear are incredible. And of course, he challenges the mainstream narrative when that's needed. Today, we're going to dive deep into the Fed, global finance. We'll talk about AI, corporate takeover, what it takes to survive and thrive in today's economic order. George, welcome to the show.
I want to be clear, Ben, it's not just your opinion, that's everyone's opinion of me. Everyone believes that I am the foremost thinker in macroeconomics. No questions about it.
Absolutely. Yes.
If you deny that, I've got some oceanfront property in Arizona to sell you.
Yes, I've been there. It's incredible property. George and I hang out there all the time. We had mojitos and we talk macro. So, George, let's start off. The macro environment is really wild. I mean, you know it's bad when you have people calling me saying, Ben, what's going on with the tariffs? What's going on with gold prices? It feels like the macro environment is in the news today. So let's kick things off. What do you think the biggest risk that is facing the economy right now? Or do you think that the headlines are just kind of having people click when in reality, things are going to be a lot more stable going forward?
Well, I would argue that we were on a downward trend prior to the tariffs. So, as an example, I did a video the other day talking about Southwest Airlines, and their CEO came out and said that I don't care what you want to call it, the airline industry is in a recession. And if you go back and look at when domestic demand really started to plummet, it was back in January. And it wasn't just right after Liberation Day. And if you look, in fact, if you look at overall travel, a lot of people have been blaming that on Trump. And there's a lot of things I'm very critical in regards to Donald Trump's policies, but you can't blame him or tariffs on the slowdown in travel, because if you look at the trend, you go all the way back to Biden and the trend is the same. The trend accelerated with Trump, that's for sure. But we were already in a massive downward trend, which would tell me that the global economy was definitely slowing down. And now you're starting to see all of these CEOs come out and pretty much say the exact same thing with, McDonald's just came out yesterday and said that their same store sales declined to the degree to which they hadn't seen since COVID, the depths of COVID. And this is, and I mean, look at all of the soft data as far as the consumer sentiment surveys, and those are all pointing in the same direction. You know, it was kind of an outlier with the Democrats there with the University of Michigan survey, but now the Republicans are pretty much, they might not be as pessimistic as the Democrats, but they're all kind of singing from the same hymn book that the labor market is dramatically deteriorating. And I think that's kind of the way to time these things. If you look at past cycles, they all kind of play out the same way. And this goes back to your original question, in that, and one of the main reasons why I thought the economy was fundamentally unsound even prior to the tariffs that we got. And I think that was just kind of the straw that broke the camel's back. But one of the main points that I would look or point towards is interest rates. So if you look at the curve, twos, tens as an example, that was inverted. Everyone knows that. Inverted for about 2 years, maybe a little over 2 years. And then you start to see the steepener, which is what you always get when the Fed starts dropping rates. And then once that curve steepens out, usually it's getting close to the time when the stuff hits the fan. Now, what you really have to look for as far as when you know definitively, because the NBER is never going to come out in real time and say that we're in a recession. And as an example, in 2008, they didn't announce that we were in a recession until December of 2008. They said, oh, yeah, by the way, we've been in a recession for the last 12 months. It's like, well, thanks. We appreciate that. So you can't rely on the NBER, but I think what you can rely on is the labor market. And the labor market right now, the hard data is not that bad. I have to admit, the SOM rule is no longer triggered. We are at 4.2. I mean, we had 177,000 in non-farm payroll today, which isn't great, but it was higher than expectations. Although I will say I don't know if you saw this, but they downwardly revised the month prior pretty substantially. I think was it from like 225 to 185, something like that? So it's just kind of this game that we've been playing and that we were playing in the Biden administration, that every headline number is kind of rosy, and then they downwardly revise the past month or the couple months prior. And so, it's not a great number. It's not horrible though. And if you look at initial claims that came out yesterday, it's starting to trend higher. I think we were at 240, 245, something like that. Maybe 220, 225, the month before. And so we're not at that threshold of 400,000 that is usually that final indicator saying that, okay, it's not that the stuff is going to hit the fan, but the stuff is hitting the fan. We're not there yet, but you see it kind of trending higher. And another thing too, that even if the underlying economy, let's say, is fundamentally sound and that everyone is just overplaying the tariffs and the impact that they're going to have on the US economy, still that goes into psychology. And it's, that old Michael Jordan saying where he said Republicans buy sneakers too. Well, Democrats buy sneakers too. And even if the Democrats are crazy and they don't know what they're talking about, they've got Trump derangement syndrome and they think the economy is bad just because they're watching CNN, but in reality, the economy is booming and yada, yada, yada. It doesn't matter if 50% of the United States has Trump derangement syndrome and therefore they're not spending. That doesn't matter. That's still regardless of why they're not spending, it's still going to heavily impact the economy. And then you go and you talk about all the other things with the uncertainty. I mean, we hear that word just constantly nonstop, but I think there's a reason for that. And that when businesses are just looking into the future and they don't know what's going to happen, then they're likely going to spend a lot less and they're going to tighten their belts. And that means more or less of the aggregate demand, more of the tightening of the belt. I was talking about, the Democrats, and you get the businesses, the small and mid-sized businesses doing the same thing. So you get more of the belt tightening, which is a further reduction of aggregate demand, which is going to negatively impact GDP. So I guess the main takeaway here is the economy, in my view, was just going through a typical cycle. It's the same cycle that we've seen going all the way back to the 1950s, where the Fed increases rates, they get to a level, they pause, the 2-year Treasury starts to drop, and then the Fed starts dropping rates, not to get ahead of an economic recession, but in response to an economic recession. And I don't see why it's different this time. And so, but it never happens overnight. And it's always kind of slow motion. And I think that's the process that we're going through right now. I'd like to, and I'm not saying that this is going to be the GFC, but I would like to highlight the fact that during the GFC 2008, yields on the 10-year Treasury, as an example, from March to July went up by almost 100 basis points. And the CPI, when the Fed started cutting, was right around 3.5, and that was September of 2007. And in July of 2008, the CPI was at 5.6. So the CPI went way up. And by the way, if you look at the Wall Street journals during that time when we had that 5.6 print on the CPI, so that would be the Wall Street Journal from August. It was early August, the day after we had that CPI. They were saying stagflation, stagflation, stagflation. The Fed cut rates way too much. They're losing control of the long end of the curve. And heading into the latter parts of 2008, they're going to have to start cutting rates again. That was the narrative in the mainstream media, in the Wall Street Journal. And 2 months later, the Fed had rates at 0. So these cycles, it's never a straight line. It's never linear. There's always back and forth. There's always volatility. And I mean, talk about volatility. That goes back to April 7th, April 9th. And when we had the stock market really falling out of bed and tons of volatility to the downside. And then you had the dollar going down. You had a huge decline in the dollar very, very quickly, which is unusual. And that was combined with yields going up. I remember the 10-year on that Monday intraday went up like 35 basis points. I mean, that is a crazy move when the stock market is declining. The VIX is at, I don't know what it was in, let's say 40, and you've got the dollar plummeting. And but it's not unprecedented. If you go back and look at history, that's exactly what happened at the in March 2020 at the beginning, and it's also exactly what happened in September of 2008. And so it's usually this dynamic, in my view, where the foreigners are selling, maybe because they have to, maybe because they want to, and that's a sign of cracks in the monetary dam, if you will. It's not necessarily just exclusively because China's giving the finger to Trump and they're quote unquote dumping all their treasuries, and therefore, they take those dollars, they buy euros to buy the German Bund or something like that. It's usually a sign of stress. And usually when foreigners are doing that, they're not doing that from a standpoint of strength. They're usually doing that from a standpoint of weakness. And the fact that it is unprecedented outside of times of extreme volatility or when the stuff is hitting the fan, I think should be a huge red flag that it's happened more recently. So, again, I don't like the tariffs. I think they're on net a bad economic policy, even for domestic manufacturing, and we can talk about that. But I would not blame the tariffs solely on on a recession if we have one. I think the economy was headed for one regardless.
So from this beginning of our discussion, I'm just hearing this is a market for gold. I mean, you have uncertainty like crazy. You have
Yeah.
economic policy. You're seeing prints that, are going sometimes in the wrong direction, being revised in the wrong direction. And for a lot of people, they're like, okay, the stock market can have intramove days, volatility like crazy. Obviously, bonds are potentially also on the chopping block as well in terms of policy. So I want to start, obviously, I want you to actually give me the pitch of why you think gold could be in a bear market, where you think actually gold could turn around here. We've had obviously a very great big bull run in gold. So first, why don't you start off giving the pitch of where you think gold could actually weaken, and then let's talk about where you think gold could continue its run.
And it's all about liquidity. It's very, very simple, actually. If you think that, let's just assume, and again, I want to be clear, we're just talking about probabilities. We're not talking about certainties. And these things are just absolutely impossible to time. And I'm not saying that, we're in a recession now. I have absolutely no idea. I'm just kind of reiterating what the data is telling me. Um, but what I am saying is that I think the cycle is likely to play out in the same way. So that means curve inverts. That means curve steepens as a result of the Fed dropping rates. You get a bull steepener, which means the front end goes down faster than the long end. And again, you got a lot of noise in between there. And that's usually when the stuff hits the fan once you see the unemployment rate spike. So I'm not saying that we're there yet. I'm just saying that in my view, my base case is this cycle plays out the exact same way that it's played out since the 1950s. And so far, the progression has been consistent, I think. So going back to what you were saying about gold, and it's all about liquidity, all about liquidity. So if we have a dot-com type of recession that's pretty much just balance sheet and you don't have a big liquidity event, then I think, this I would not be surprised if we get to the bottom here in this most recent pullback very, very quickly. That said, if you are in the camp that this is not going to be just a balance sheet recession, if we do have a recession, but it's going to be more systemic, which would create a liquidity event similar to the GFC, then gold could go down substantially, but that's your buying opportunity. So it's really where, first and foremost, is your base case we go into recession? If yes, Is your base case we have a liquidity event or we don't have a liquidity event? If your base case is we have a liquidity event, then we probably haven't seen the bottom yet in gold. If your base case is we will not have a liquidity event, then we're probably pretty close.
So we spoke with Bob Murphy on the channel. He's an economist, friend of yours,
Very good.
WWE macro combatant. And Bob was talking a lot about what you were saying with this yield curve and the uninversion, how basically it's been a 100% accurate indicator of an upcoming recession. Now, he said, to be fair, this round of yield curve inverting and uninverting has been the longest by far we've ever had.
I don't know that it has. Right,
Okay, tell
and
me.
the reason I say that is because in the mid I mean, I don't know how to do a screen share, I could pull up charts just to be precise, but if you go back to the curve inverting during the GFC, that and your viewers can fact check me on this one, I don't have the chart in front of me, I was doing this right off the top of my head. I believe it inverted in 2006, and I'm almost positive it was inverted a good or from the beginning of the inversion to the point where we started recession, it was at least 2 years. Maybe 2 years, 1 month, 2 years, 3 months, something like that. But the thing is, if we would have been in the middle of 2008, we would have been saying the same thing. We would have been saying, "Oh, well, the recession isn't here. The recession obviously isn't here. That stupid yield curve, well, that's dead. You might as well throw that away as an indicator." It's because the NBER didn't announce that we had been in a recession until December. A year late. And then you look in the rearview mirror, and then you're like, "Oh, yeah, it started in, let's say, January of 2008, which shrinks the time from when the yield curve inverted to when that recession hit." So my point is, I mean, we could be in a recession right now. I mean, let's not forget we had a negative quarter GDP, right? And I get it. There's a lot of nuance to that because of front running tariffs and everything. But I could make just as easy a bear argument for that negative -0.3 print, even considering the front running of the tariffs and whatnot because of inventories and a lot of other things. I could make just as easy a bear argument as I could a bull argument. So we've already had a quarter negative GDP, right? And let's also remember that when the NBER did come out in 2008 in December, they revised everything. Everything got revised down. So, when you're sitting there in the middle of, let's just say March of 2008, you're like, "Oh, wow, unemployment's not that bad. Oh, wow, no negative GDP yet. It's nothing but rainbows, sunshine, and blue skies." Well, stop all that fear mongering that you've got there. That stupid yield curve. Just forget about it. And then when we actually get the announcement, then they go ahead and revise everything down. You're like, "Oh yeah, that positive print was a negative 4%," or I'm just making this up just to illustrate the example. But I mean, we could be in the middle of that right now. So I would kind of just shelf the idea that we're a lot longer in the tooth than 2008. Maybe we are, but maybe we're not.
So I've heard some arguments that this time around, the Fed is being hyper vigilant. They're keeping an eye on every little crack that can appear. And this time, they're going to move faster than ever. Give me the George Gammon take on that conspiracy theory.
Easy. Look at the 2 year. 2 year. The Fed always follows the 2 year. Always. And it is way up today because we got the non-farm payroll that exceeded expectations, although it was bad. I think that's a knee-jerk reaction, and I would be willing to bet that in the next couple of weeks, the 2 year will go right back down to where it was under 3.6. So let's just assume right now that we fast forward to next week, the 2 year is down 3.6, call it. Fed funds is at 4.33. So and the Fed always follows the 2 year. I mean, don't take my word on it. Your viewers can just look up a Fred chart of the Fed funds versus the 2 year Treasury yield. And when you do that, you see that and it's not just on the way down, it's on the way up as well. The 2 year Treasury always goes first, and then the Fed races to catch up. And usually by the time they catch up, then it's going back the other way, and they're just getting whipsawed back and forth. The Fed, getting whipsawed back and forth. They're always behind. The market is always ahead of the Federal Reserve, always. I mean, look at them right now, for heaven's sakes. They're sitting there worried about inflation. Like, what are you even doing? I mean, look, the CPI is down to 2.5%. Now, I am not saying that this is an accurate reflection of overall price increases, but I am saying that it's a decent proxy for the trend. And so it's down from 2.8 to 2.4. Why? Well, that's mostly because of energy prices. Okay, well, if you look right now, oil is plummeting. I mean, you want to talk about a recession indicator. Oil today is down like 58 bucks, right? Down from, what was it, a month or two ago, maybe 70, something
Yeah, it
like
was
that.
low 70s.
Yeah, so I mean, it's down huge, and it's mostly down due to demand or demand expectations declining, right? So my point there is the last CPI print included energy prices from March. And the report said that that was the main reason we went from 2.8 to 2.4. Okay, well, what are energy prices doing in April? As far as I can tell, I don't know what the price of gas is doing, but I would assume that there's a correlation between gas and oil. And if so, then the energy prices for the next CPI print are going to be even lower. Now, are the tariffs going to offset that? Maybe, I don't know, maybe not. But all else being equal, you would see a CPI print of maybe even 2%. And last time I checked, that was the Fed's target. Now I know it's not CPI. They look at they look at another metric there.
PCE, all these other metrics, right?
Yeah, there's one that they really get hyper focused on. But again, we're using that as a proxy of the overall trend. So I mean, that is one thing that I totally agree with Besant and Trump. Now, I don't, they may be saying that Powell should lower interest rates to reduce the interest on the debt or whatever it is, and I don't really buy into that. But I do believe that if we're just looking at the market, what the market is saying, the market is screaming that Jerome Powell should be reducing rates, and you don't have to take my word on it. Just look at the 2-year Treasury. So, but look, this is not the first time that the Fed has been off sides. They're always offside. I mean, just go back in history. The Fed is always, 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 always behind the curve. So it's just crazy to me that everyone hangs on their every single word and just assumes that they're going to be ahead of the curve this time when they never, ever, ever have been in the past, right? I was listening to one of my favorite podcasts today, and one of the speakers who's, really been in markets for a long, long time trading, he said, if I can't tell you why the price is where it is today, then I can't tell you where the price is going tomorrow. I have to know. And if I don't know, I'm on the sidelines, right? So it's the same thing with the Fed. If they can't tell you specifically, what's going on right now, how on earth can they ever predict the future? And the bottom line is they can't, because they never, ever, no matter how many econometric models they have, no matter how many beige books they have, no matter how many PhDs they have, they don't have as much information as the market. They never, ever, ever will. And this is why the market always leads the Fed. But what's just bizarre to me is the CNBC types and the talking heads and the experts, they think it's the opposite, right? They think somehow the Fed like dictates where the market goes. Like, oh, well, my gosh, to avoid a recession, the Fed just got to drop rates and then we won't have a recession. As if that's ever happened in the past, right? And it's wild to me that you can just look throughout history and you've basically got a baseball player with a batting average of 0. Literally 0. But yet for some reason, we're looking at that same baseball player and hanging on their every word, and when the game is in the 9th inning and we've got to have a home run, for some reason, we're putting that guy at the plate. Instead of taking the marketplace, which is your guy that's, got a 400 batting average and hits 50 home runs a year or whatever. I mean, that's what we're doing. We're ignoring or golf, we're ignoring Tiger Woods. We're getting 2 lessons here, right? One from Tiger Woods and one from some guy who's a 30 handicap. And not even that, like a 40 handicap. The guy's never broken 100. And for some reason, we're taking the advice of the guy that's never broken 100 as opposed to the advice of Tiger Woods. I don't get it.
George, for those who are only listening and not getting to view our beautiful faces, you're wearing an End the Fed hat and an End the Fed shirt. So
Yeah.
let I'm in full agreement. I think we should end the Fed, but do you think that there is appetite for that with the current administration? Do you think there's a Powell versus Trump header that's going to happen here, or do you think that the Fed remains in control? Trump will tweet or post something about how he's unhappy, but at the end of the day, their independence remains.
I think their independence is going to remain. I don't see that as a high probability that the Fed, but then you got to ask, are they political to begin with? Um, maybe, maybe not. But I think what's even more important is the reason why I wear an End the Fed hat. It's not the same reason why most people would want to end the Fed, because most people want to end the Fed because they believe that the Fed controls the economy, and they believe that the Fed controls the dollar, and they believe that the Fed controls interest rates as opposed to respond to interest rates, right? And I don't believe that. I don't believe that if the Fed does quantitative easing, as an example, and takes their balance sheet from whatever, call it 6 trillion up to 6.5 trillion, I don't think that has any impact at all. I can't see the evidence for that. And if you really understand how the monetary system works, you realize that banks really don't need bank reserves. And the evidence that I would point to is in 2007, prior to QE, the Federal Reserve had about 40 billion in bank reserves, right? So those are the bank reserves that the banks were actually using for interbank settlement, right? And this is in where M2 is 7.5 trillion. And by the way, you go back to 1980 and the system had 40 billion in bank reserves. Exact same amount, but M2 was 1.5 trillion. And by the way, that's not just that's exclusively US M2. That does not include global M2. So think about what global M2 in dollars, or not just global M2, but global dollar M2 is the way I should say it. Think about what that was if the domestic economy was 7.5 trillion. I mean, we were probably at, I mean, there's no way to actually quantify it totally because of the shadow banking system and whatnot, but you would have to assume that there's at least 30 or 40 trillion dollars outside and inside the United States, and that's backed up with 40 billion in reserves. And you're telling me that somehow the banks were using those for interbank now they were using them to some degree, but the bottom line there is the banks can settle on their own balance sheet. They don't need the Fed's balance sheet to do that. So the point is that the Fed isn't at the center of the monetary solar system. The banks are. And so if they're not at the center of the solar system or the monetary solar system, and they don't really control rates, they just kind of more follow rates and manipulate them, then why should we end the Fed? This is the question that I always get. And it's because they're distorting markets, not through mechanics, but through psychology. And the example I always use is one of these Indian witch doctors, right, that they had that would do the rain dance. So everyone thinks that the witch doctor makes it rain. That when they come out of their teepee or whatever it is, and they do their march around the fire for an hour, oh my gosh, you better get ready. So all the other Indians are going to go out there and they're going to load up on seeds, they're going to load up on fertilizer, they're going to go down to local Home Depot or whatever, and they're going to take all their savings and they're going to dump it into planting more corn and growing more crops because, oh my gosh, the witch doctor guy just did 3 laps around the fire. And we know that it's going to pour for the next 6 months, right? So that is a huge misallocation of resources. This is malinvestment, right? Because it might rain, it might not. They don't realize that that guy doesn't control the weather patterns. Whereas if we didn't have the witch doctor, or no one paid attention to the witch doctor and they actually paid attention to science, then they could better predict the weather patterns, and then they wouldn't misallocate those resources, and we wouldn't have the same degree of malinvestment. You see, this is why we have to end the Fed. It's not because they really mechanically make a difference. It's because psychologically, everyone thinks they do, and therefore they take action based on this belief, and then it's a self-fulfilling prophecy, and then we get markets just wildly distorted at all-time highs. I know the CAPE ratio is down lately, but it was at like a 38 when we could have taken that capital, and instead of thinking, "Oh my gosh, let's just dump it into the market because the Fed's doing QE," we could have taken that capital and allocated it to, I don't know, how about creating more goods and services? And that, at the end of the day, is true wealth, and growing the real economy instead of growing the financial economy. You see, this is my point about the Fed, and it's something that I think most people really overlook because they want to believe, even the Austrians, like even my buddy Bob Murphy, right? And I've told Bob this many, many times. I'm like, that you're doing the Fed's bidding, right? And and what I mean by that is if you go out there and say the Fed is doing this, the Fed is doing that, the Fed is doing, the money printing and blah 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 blah, that's exactly what they want you to do. That's what they want you to do because they don't have any mechanical control over anything. The only thing they have is psychology. So if you get my buddy Bob Murphy or my buddy Peter Schiff or my buddy Doug Casey or any of these guys out there saying that the Fed is doing that they're playing right into their hands. What we have to do is we have to go out there and say, stop paying attention to the Fed. Look at the marketplace. Ignore the Fed. They don't matter. They don't do anything. The only thing the Fed does do, and this is, I want to give a huge shout out to my great friend Lynn Alden, and she'll point this out, that they bail out the banks. And that absolutely, unequivocally, without a doubt, makes a big difference. That plays into the psychology. But it isn't necessarily because the banks don't have enough reserves. It's just the banks aren't willing to lend to other banks. So they have the ability to, they just don't have the willingness. But outside of times of crisis, like 2008 or when they set up the BTFP, that's a perfect example. Outside of times like that, the balance sheet, in my view, really doesn't matter. Hopefully that
So
makes sense. And I'm sure I pissed off every single one of your viewers.
Well, that's good. They like getting pissed off, and they let us know in the comments what you think. And so it sounds like what you're saying is, in general, people are over-indexing on the Fed. They hear the Fed say, we're raising rates, we're lowering rates, we want this program, we want that program, and the markets move incredibly because of these few pronouncements, when in reality, the real economy, things that have actually changed, like, consumer saving or the power of AI, that hasn't really changed with interest rates. And you feel like there is a kind of a cat and mouse game where the markets are moving because of the Fed's pronouncements, even though the Fed's pronouncements are really just that, they're pronouncements. And so, what is something?
I think you could. A lot of people will say, "Oh, George, well, if you look at a chart of the Fed's balance sheet and you look at the chart of the S&P, they're tight at the hip. So obviously, QE mechanically does make a difference." And I'll say, "Okay, but why don't we zoom out a little bit?" Right? So what I mean by that is let's just look at how much the market went up 1990 to 2000, right? And then compare that to how much the S&P 500 went up 2010 to 2020. And in percentage terms, it went up more from 1990 to 2000. Well, how? The Fed wasn't doing QE. So, so if anything, you could argue that QE actually was a retardant. That QE actually reduced the S&P to a level where it actually would have been higher without the QE, right? Because if I can sit there and point at times where, let's just say there was I don't have the chart in front of me, but let's just say in the 1990s, we had a 50% increase in the S&P 500. And from 2010 to 2020, we had a 40%, right? If I can point to a time with no QE where the stock market went up, you at the very least have to scratch your head and say, okay, maybe, just maybe, there's a variable here that might be slightly more important than just the Fed's balance sheet. You see? And another thing that I'd like to point out, which I think your viewers might find interesting, is in the late 90s, I think they might do it today, but I always looked at the late 90s. And the Fed would come out reports at the end of the year summarizing their open market operations, right? And this was, again, when they only had 40 billion, so they weren't doing that much. And they openly, explicitly say that they did not create reserves and then the banks would lend. It was the opposite. So therefore, the opposite of what you hear in the mainstream media, the opposite of what you hear not just from the Austrians but the Keynesians as well, because the way they have this money multiplier thing where they think that the Fed creates reserves, and then the bank's like, oh great, we have all these extra reserves, now we can go out and lend more and create more M2 money supply. It was the opposite. So what would happen if you read these reports is the Fed would sit there and look at what the level of bank lending was in the last quarter. And then they would try to project out over the next quarter what the amount of bank lending would be. And then they would go ahead and create as many, even though they weren't using them, or they didn't need them, let's say. But then they would create the amount of reserves in advance that they thought the banks would need based on last quarter's lending trajectory. Right? So again, it's completely backwards. The banks would lend, and then the Fed would create the reserves to back up the lending that they thought the banks needed, right? When the mainstream just has it, and on both sides, right? They look at it in the complete opposite way. So I don't want to drone on here because I know we've got a lot of things to talk about, but in fact, check me on this stuff. I would strongly encourage your viewers to just look at a chart of bank reserves, a Fred chart. You can pull it up in 10 seconds and look at it from 1980 to 2007. And then look at a chart of M2 money supply and ask yourself, how is this possible if the Fed was at the center of the monetary solar system? And so that end of rant.
George, you did say you do think the Fed has one important tool that they really do use, which is bailing out banks that are in trouble. So
Yeah.
we saw
And that's the
a
worst thing. That's probably the biggest reason we should end the Fed, because we have to go back to a free market economy. And in a free market, like Milton Friedman always says, the loss is just as important as the profit. In fact, who was the person that said that that bailing out the banks and whatnot, it's like Catholicism without hell or something? I forgot who said that. I'm probably butchering the quote. But yeah, we've got to go back to good old-fashioned free market capitalism instead of this crony capitalism where we're bailing everyone out. We got to let people fail. We got to let banks fail. And unfortunately, I apologize, but if we allow banks to fail, there might be some depositors that take a haircut on that. And you just got to be more prudent about what you're doing with your savings and where you're putting your money and what the bank's balance sheet looks like. But that's, I think, the best way that I mean, here's another thought experiment for you. I trace this whole, the Fed is just at the center of the monetary solar system, and whatever they do, that leads to asset prices going up and the Fed put. And I take this all back to Greenspan, right? Especially with long-term capital management. That was the first time when they kind of got involved with a bailout. It wasn't directly, it was indirectly, but that was the first time where they kind of drew this line in the sand or explicitly made it evident to the market that they weren't going to allow people to fail if it was systemic, let's say. And then you had, the GFC, then you had Greenspan. Every little time you would get into, back then the market didn't even need to go down. Remember Y2K? I mean, you're probably too young to remember that, but I'm sure a lot of your viewers remember then that was supposed to be the end of the world because all the computers only had like 2 digits or whatever instead of the 4 digits. That was supposed to bring down the whole entire planet. So what Greenspan did is he actually dropped rates to get ahead of that. So he was sitting there tinkering and doing all this crazy micromanagement, which is why people started paying more and more attention to the Fed. But you have to you have to kind of go through this thought experiment and ask yourself, if they never would have bailed out long-term capital management, if they never would have done bailouts during the GFC, and let's just assume for a moment that they never did those bailouts, but they did QE, right? But they let them think, they let everyone fail, but they also did QE to take their balance sheet to the same level. Do you actually think the stock market would be where it is today? I mean, I don't. I think there's an extremely low probability because people would take that capital and they would there it's always a risk reward, right? Always a risk reward. And what you're doing by taking away the Fed put, if you want to call it that, is you're increasing the level of risk. Okay, well, then they would need more reward to go ahead and allocate that capital. And if they're not getting it, they're going to take that capital and they're going to look for a place where it's better served. And what that's always been in the past, before we financialized the economy, was in the real economy, creating goods and services that actually made us richer as a society. So that to me, that is the number one reason we should end the Fed, to get rid of the stupid bailouts and go back to a free market.
Do you think that that desire to focus on the real economy, push away from financialization, do you think that's something that's happening now? Tariffs maybe being a misguided way to do it, but do you think there's a focus now on the real economy where people are saying, "Hey, listen, I don't know what the problem is, but I want it fixed," and we might be seeing the beginnings of at least a push towards that realm?
Yeah, so long as there's not a recession. It's you there are no atheists in the foxhole, right? So you sit there and claim, you know, that, "Oh, yeah, I wanna take the punishment, I wanna take the pain, we gotta take the medicine," whatever it is, and we've got to, get rid of this financialized economy. And that's all fine and dandy, and everyone's, singing from the same hymn book until the unemployment rate goes up to 10%, until you have the crisis, until you have the economic pain, and then, especially today, we just we just wave the white flag as fast as we possibly can. I mean, the COVID was a perfect example, right? So, I think that and another way to look at it is look at how the bailouts have progressed, right? We start with just long-term capital management. Then you go to, what was it? TARP, I believe, was the bailout in the GFC. What was that? 800 billion. I mean, that's like a rounding error compared to what we did during COVID, and it's a lot faster too. The response time is a lot quicker, which tells me that, you know, you know, uh, forget the talk. Let's just look at the actions. And the actions are telling me that the American people as a society can tolerate less pain, not more pain, regardless of what they tell you on Twitter, or regardless of what they say, or regardless of even how they vote. And Trump likes to say that he doesn't care about the stock market and all these things. Okay, but he does care about a recession. He does care about a depression. How do I know that? Because he told us, right? Remember when the bond market froze up? What was that, April 9th, 10th, something like that? And all of a sudden, the very next day, he's like, "Oh yeah, sorry, we're gonna do a 90-day pause." All the chest beating and everything that I did before, and I'll just forget that for a moment. And if you have any doubts, don't worry, art of the deal, right? 5D chess. But he comes out and does the 90-day pause, and he explicitly said, "Because I'm cool with a recession, but I'm not cool with a depression." And then let's also look at another thing they're trying to do, if we take them at their word, is they're trying to reduce the deficit. What's gonna happen in a recession? The deficit's gonna skyrocket in a recession, right? And that's not even if they spend much, or spend that much more, which they will, but it's, the tax receipts will plummet. I don't care what the tax rate is. The tax receipts will absolutely plummet, right? Because tax receipts, as of the last 30 years, really tied at the hip with equities. And so if that goes down, so are your tax receipts. So, and then look at what Trump did during the surveillance sickness. I mean, let's remember that the stimmies, that was not because of Joe Biden. That stimmies, the PPP, the lockdown, all that stuff, that was under Trump. That was not under Kamala Harris or Joe Biden, or or whoever you want to blame it on, right? So if you're pissed off that we had the huge consumer price inflation of 2021, 2022, you gotta lay some of the blame on Trump. And if his actions of the past can help us predict what he has the tendency to do, or may have the tendency to do in the future, if we go into, unemployment, let's just assume for a moment that spikes up to 7, 8%. The stock market goes down by another 20%. We start to see housing going down, and you do get a couple quarters where it's obvious that we have negative real GDP. I see Trump doing something. He might not lift the tariffs. He might still talk a tough game there and try to negotiate these deals and whatnot. But I think that the fiscal side of the equation will definitely change quite substantially. And if that happens, then the Fed is going to have a lot of cover to go ahead and cut rates, because in that environment, we're not going to see the CPI, skyrocketing. Even if we do have tariffs, likely the CPI is going to come down. A lot of people talk about stagflation. And I like to point out that during the 1970s, when we had those recessions, they were disinflationary. I don't know that they've looked at a chart, because they just assume that the inflation rate just went up constantly throughout the entire 1970s, and it didn't. It absolutely did not. So, as an example, 74, 75, when we had that recession, when and again, I don't have the chart in front of me. I think that the CPI topped out around 10, 11, something like that. And then once you had the unemployment rate spike, which is what we see in pretty much every single recession, then you saw disinflation, where the CPI went from, let's just say it was 11. It went down to maybe 4, 5, something like that. But it did that over a 2-year span. So within the 1970s, you had disinflation for 2 years. Now, it is true that uh, the CPI was still high. I mean, 4 is still way above where it should be. But it just goes to show you that our starting point right now, or if our starting point is 2.4, or let's just say it's even 3, the probability that it's going to be higher than 3 once you see that unemployment spike is incredibly low, even with the tariffs. Because back in the 1970s, it was oil. Remember, we had the oil skyrocketing. So if oil is an input to every single cost, how do we not have accelerating inflation? How do we have decelerating inflation? And the answer is because if incomes aren't going up at the same level, whether it's oil or tariffs or whatever it is, the consumer is having to rob Peter to pay Paul. So you have some prices going up, but because that aggregate demand is being taken away from another part of the economy, you have those prices going down to the point where the unemployment rate goes up, and then these prices have to come down as well, which is when you get that overall or that rapid decline in the CPI. So I don't see, I like these cycles. I guess I'm just kind of a cycles person, especially if there's, like a 99, 90 or 95% correlation. And so that's another one of those things where I don't know why it would be any different this time. Another thing too that's interesting is the money supply. So people will say, well, this time, if we go into a recession, we're going to see the inflation rate skyrocket because we had all the quote unquote money printing from 2020 to 2022 when the M2 money supply went up by 20 or 25%. But what's really interesting is if you go back to 70 to 74, the money supply growth was actually higher than it was from 2020 to 2024. It was higher in the 1970s, and we still had disinflation with the recession. So, anyway, that's why I'm not. I don't really like treasuries, but in this type of environment, I tell you what, I'd rather own treasuries than equities for sure.
George, as we head towards the end of our interview, I want to do a lightning round with you. You can answer as short as you want, as long as you want. And let's start here with gold, Bitcoin, and farmland. For the next part of Trump's term, which do you think is going to outperform the most?
Wow, that's a toughie. Good question. The conservative investor in me, which is what I am at the end of the day, would say gold. But this if I'm going to harness my inner speculator, like my good friend Doug Casey, I would I would probably go with Bitcoin. Um, no, I'm gonna stick with gold. I'm gonna stick with gold. And the reason I'm gonna stick with gold is because I know why the price is where it is today, and therefore I'm comfortable having a base case or a prediction as to where it will be in the future. Where with Bitcoin today, I don't know, to be honest with you. I don't know why it's at 97,000 as opposed to 87 or 107. And therefore, I'm just going to try to play it right down the middle and be a little bit more prudent about it. As far as farmland, I haven't really looked into it, so I don't have an edge. I don't know if it's cheap right now. I don't know if it's expensive. So I don't really have an opinion on it, other than the fact that I do really like commodities. I think we're in a commodity super cycle, but that doesn't really mean that commodities go up over the next year.
Okay, next one for you. So you've had tons of rebel capitalist guests on your show. Who's someone that came on you thought, oh, I'm going to clash with this person, but you ended up agreeing with them and vice versa?
Well, I interviewed, what was the gentleman's name? He likes to claim that he's a communist, but he's a professor. Is it Professor Wolf? Richard
Richard
Wolf?
Wolf,
Does
yes.
that sound right to you?
From my alma mater, UMass Amherst.
Okay. So, I interviewed, and I apologize, Richard, but that was, I think 2020 when I interviewed him, so it was quite a while ago. And he he likes to be, I think, a little, hyperbolic. I think he likes to kind of ruffle feathers, which is why he calls himself a communist. He's more someone that just believes that the workers should own the equity in the company when rubber meets the road, and it's not too completely, it's not like he's just, he might say that he's a diehard Marxist, but he's not. He's really not. So I had a lot more, I don't know if in common, but I disagreed with him on a lot less than I thought I would. That's, that's probably the person that sticks out the most.
Okay, next one for you, George. So, in one sentence, what is money?
I would answer that by telling you what most people perceive money to be. And most people perceive money to be commercial bank deposit liabilities. At the end of the day, that's what most people think money is. So if they look at their checking account balance and they have $1,000 in there, they think that they have money in the bank. And that is nothing more than, it's an illusion. There's no money in the bank. It's just simply an IOU. It's a receipt. So I think most people see money as a commercial bank liability. They don't think of it in those terms. They think of it money as a bank, but technically that's what it is. And the reason I would focus on that definition more so than my good buddy Mike Maloney, which if you want to get into it is actually the proper definition of money. It's because what the public perceives money to be is what is most important when you're trying to figure out the monetary system, when you're trying to figure out interest rates, the gold, silver, Bitcoin, farmland, whatever it is, right? Because it's not about what you think, it's about what the market thinks when you're setting up a portfolio. And the market believes money is fiat currency. And fiat currency in today's modern monetary system is not green pieces of paper. It's a very small fraction. It's just simply commercial bank deposit liabilities. And once you understand that, I think you have a much better understanding as to how the monetary system works. And by the way, you have a much better understanding as to why the Fed's balance sheet really doesn't matter at the end of the day, and why the banks are at the center of the monetary solar system, because there is no limit to the amount of commercial bank deposit liabilities banks can create. They can create their own assets. They can create their own liabilities, right? What they can't create are green pieces of paper. or they can't create gold, or something like this. But they can't create green pieces of paper. So if you understand that the financial players, the whole entire world, other than some Austrians and sound money guys, see money as something that commercial banks can literally create an infinite amount of, with or without the Fed, by the way, then I think it helps you better understand the system, which in turn will help you better set up your portfolio.
What's an underrated asset that people don't have in their portfolio or don't think about often enough?
Well, right now it'd probably be miners, but that's your audience is going to be quite a bit different. If you had, the average Joe and Jane, I think they're underweight miners probably. But what else? Oh, you know what I'd probably say is long volatility. Yeah, that would be it. Because if you think about volatility, most people think they have a diversified portfolio, but it's not. Because they'll say, "Oh, well, I'm completely diversified because I own commodities, I own equities, and I own real estate." Uh, okay, that's all short vol. And I can explain that if you like. That's all assuming that volatility is going to decrease. Because if we go into an environment where volatility is ever increasing, then it's likely that all three of those asset classes go down. So you're not diversified, right? A true diversification would be if you have a portfolio that is hedged for volatility, and you had components of your portfolio that were long volatility. And I think that's most people's blind spot.
An important factor. Last question for you on this rapid fire round. Where do you see silver? Obviously, the gold to silver ratio has been way out of whack for people who follow it. Do you think that silver is just becoming a more industrial type metal, or do you think that the monetary aspects of silver are going to shine in the coming years?
Oh, in the coming years, I would say so. But over the next 6 months or a year, I think the gold silver ratio is where it is for a reason. And I think the market's pretty much telling you everything you need to know. Because it is true that you've got that industrial component, like you said. And I think that silver is just telling us that there's a high probability of a recession. And so I would much prefer to buy silver, especially if gold dips. If we do have a liquidity event and gold goes down by, let's just say 15-20% or something like that, usually what triggers the reversal of that move is the Fed coming in and doing the psyops that we talked about earlier, like like QE, and then all of a sudden the market's like, "Woohoo! The Fed's got our back." Psychologically they do, mechanically they don't really have it, but let's just assume that's what the market thinks, and it's not about what we think; it's about what the market thinks. And once you get past the liquidity event, then silver probably takes it on the chin even more than gold, and that's when I would want to be overweight silver, as far as a speculation.
George, final question I ask all guests. What's a question I should be asking all future guests of the Gold Exchange podcast?
How many electronic reserves did the Fed have on their balance sheet in 1950 compared to 2007?
I love it. Nice and technical. George, where can people find more Rebel Capitalist and more you?
You can go to the Rebel Capitalist YouTube channel, George Gammon YouTube channel, or on Twitter. I'm Rumble. I'm probably overexposed. I'm everywhere on the internet.
George, it's been great speaking with you. Thanks so much.
Thank you.